The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The calm after the storm. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Nice to have you back. We missed you during the storm.
Yeah, well, I'm happy to be back on this, Touchdown Tuesday?
No, Turnaround Tuesday. Throwback Thursday. All right, let's check in where we stand. And this is a great Turnaround Tuesday moment. You just look at the VIX and look at the S&P, and that tells the whole story. S&P up 2% around the highs of the session. The VIX, we haven't seen this decline since about 1990, going all the way back there. Plus, more importantly almost, the S&P is above that 200-day moving average at about 50.16. We were really dicey there yesterday, and we're above that, and we did breach 5,300 for a moment. So that Turnaround Tuesday, in effect, does it last, Romaine?
A textbook example, of course, of that Turnaround Tuesday. Bloomberg News actually crunching the numbers here and finding that of the 582 times that the S&P plunged on a consecutive Thursday, Friday, and Monday, the following Tuesday, we did indeed see a rebound. That's unfolding today. But the underpinnings of that three-day sell-off, including downward shifts in the economic outlook, haven't actually been resolved. And that's giving Peter Schier pause about buying the dip.
And yesterday, all anyone talked about is don't panic, don't sell. But maybe you should be selling, because I think we're going to break through the 200-day moving averages, and that could create a vacuum with this sort of liquidity.
And that 200-day moving average sits just a smidge above the 5,000 level. A level analyst over at Spot Gamma say would be where downside hedging pressures subside. Strategists at Citi, though, they say be careful as risks are still tilted to a further unwind, despite quants over at JP Morgan saying institutional investors are already buying that dip, and Goldman strategists saying historically, a slump of the scale that we just witnessed has usually been profitable in the 3 months that follow. That's the setup into today, as we also have a close eye on U.S. politics. That's back on the radar of investors with the Democratic Party's revamped presidential ticket finally taking shape. Kamala Harris tapping Minnesota Governor Tim Walz as her running mate, a somewhat conventional pick designed to broaden the ticket's appeal across cultural and political lines in the U.S. Midwest and those coastal communities down south. Alex, we're going to talk about that a little bit later in the day. But let's get back to this Turnaround Tuesday, a big one indeed.
Yep, and this chart honestly tells the entire story. So this is just the one-day change on the S&P, and the bottom part here is the VIX. And you see how we did pretty much nothing for a really long time, and then get this last couple weeks of volatility and just the big swings that we've seen. And just yesterday, this was the decline that we saw within the S&P, and this was Friday. And then what's happening today? Boom, over 2% on the upside when it comes to the S&P. Now, Romaine was talking about who's buying, and he was saying that JP Morgan says that there was $14 billion of institutional net buying on Monday. Goldman Sachs also saying that hedge funds bought tech stocks, and ETF fund investors poured over $4 billion net into stock funds on Monday as well. So there was definitely the buy the dip kind of scenario. Again, though, does that last?
Yeah, absolutely, though. It's a pretty big day here. 450 stocks in the S&P 500 moving higher on the day. The equity story certainly being a picture painted as Alex laid it out there, but still some questions right now about what's going on in the bond market, particularly when it comes to credit. Winnie Cisar joining us right now, Global Head of Strategy over at Creditsights, as we kick you off to the close here on this Tuesday afternoon. And Winnie, I mean, probably one of the more surprising things about the big sell-off that we had over the last couple of days, particularly with yesterday's moves, with finally that blowout in spreads that I think people had predicted like about a year and a half ago. So I guess we got it. The question is, does that widening of spreads that we saw yesterday, do you think that's going to resume at some point soon in the future?
Hey, Romaine. Yes, indeed, we do. We have had a more cautious bias as we had not seen spread volatility this year. And as you noted, a lot of people had been expecting to see some of it, especially amid earlier in the year rates market volatility and some blips of equity market volatility. We've had a more cautious stance in the August through October timeframe on a combination of a decelerating consumer, some expectations around a slowing kind of AI trade, and then also expecting that the political headlines and volatility would probably ramp up alongside some broader seasonal weakness. So we're sticking with that caution for the near term. You're also seeing that caution in the equity market. A lot of people saying that maybe, just maybe,
the rebound that we're seeing today might be a bit of a head fake. When you look at the fixed income space, and let's just stick with treasuries for a second here, and that big drop that we saw in yields, basically at least on the shorter end, 2, 5, and 10 years now, all below 4% here. Do you think it's justified for yields to be down at those levels at this particular moment, given that we still have not heard from the Fed?
Well, it's interesting because our year-end forecast on the 10-year Treasury is 375, and we've had a more dovish bias for Fed cuts, which really until the end of last week looked very off-market. And now, in fact, the market has gotten way ahead of our pricing. And so we do think that there's probably going to be a little bit more retracement. We've been constructive on duration, but we'd hold off getting back in if the 10-year Treasury is sub 4%. And we do think that there's going to be some recalibration around Fed cutting expectations over the next few months into year-end 2024. So we are expecting to see yields rise a bit across the curve.
Right, like a new range again after the turmoil. Winnie, what do you do with corporate credit? What did we learn over the last 48 hours of the cracks in corporate credit?
Well, I think that we learned that there are some crowded long positions across corporate credit. This is consistent with a number of clients that I've spoken to over really the past 6 months who have been pretty favorable on credit fundamentals and all-in yield evaluations. But spreads were objectively quite tight. And I think that there will be this continued recalibration on the spread side of things as we understand better what the actual momentum within the U.S. economy is going to look like and where Fed cutting is. So with that, we still have a bit of an up in quality bias with some kind of contrarian trades in a more choppy market. We do like the financial sector in investment grade still. We still like energy from a kind of sleep at night carry trade perspective. And we're not entirely throwing the consumer complex out. We still think that there are some pockets of value in things like cruises and home builders as well.
What about in the junk bond market, though? I mean, recently high yield spreads were like 3%. Now they're at the highest since last December. What do you do in the junk bond market?
So within the junk bond market, we have really liked the BB sector. We think that the mix of fundamental quality and all-in valuations, especially on a yield basis, have looked pretty attractive. We get a little bit more hesitant when we start going into single Bs and triple Cs. There is the potential for some pretty strong total return performance, but this also requires that the primary market reopens with a pretty strong momentum to continue to provide liquidity to those lower rated issuers. And we think that there's going to be a little bit more of a stumbling block to get investors to really step up and buy lower rated deals when you've been coming off of such material volatility in the market.
Well, that's what I'm curious about. What actually sort of gooses the primary market more in the sense? Is it more clarity on the economic conditions or what?
Yeah, I think so. We have a number of pretty key economic indicators coming up in the next few weeks. Next week, we'll have CPI. If we get a upside surprise on inflation data, I think that's going to really throw the market into a pretty significant tizzy. And then people are going to absolutely be parsing any and all job-related data, be it initial jobless claims or having to wait for the August payrolls report in early September. So I think there's going to be a little bit of a sit and wait type of mentality, especially for LevFin investors in the near term.
All right, Winnie, always a great conversation. Winnie Cisar, Global Head of Strategy over at Creditsights, kicking us off to the close here on this Turnaround Tuesday. Coming up, a conversation with the CEO of Sunnova Energy, his outlook on green energy demand and the resiliency of the U.S. power grid. Plus, CrowdStrike rises on its first upgrade since the infamous IT outage. We're going to speak to Piper's Rob Owens about why he is turning positive on the stock. That's in today's Top Calls. And banking. Going Hollywood, the creators of HBO's Industry series, joining us for a behind-the-scenes look at the hit drama. All that and more coming up in a second, right here on The Close on Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks. Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
The news of the morning, Vice President Kamala Harris decides on a running mate, Minnesota Governor Tim Walz. Terry Haynes over Pangea writing soon after that she chose poorly, adding that Walz's pick is a signal that Harris feels unsteady and tentative on her POTUS nominee perch, just at the time when she needs to look and be leading and in control of her campaign and her political destiny. Joining us to discuss the pick now is Andy Blocker, Global Head of Public Policy and Head of U.S. Government Affairs over at Invesco. Andy, those are pretty harsh words. Do you agree with that?
Well, look, I mean, everyone's going to have their opinion. I think the first rule of picking a VP is first do no harm. Mm-hmm. And he was endorsed by Bernie Sanders on one side of the aisle and Joe Manchin on the other side of the spectrum of the Democratic Party. And I think another important consideration is the comfort level of the choice. And so clearly she's comfortable with him. And I think, he could be a good choice. Depends on how he performs.
We have, 90 days? Like, we are counting down in a big, big way. It's not a lot of time to sort of make your case. Where are the biggest policy differences that do you think the Walz-Harris ticket can put forth?
Well, I think, look, there's clearly the number one issue, I think, politically will be abortion. And will be, a woman's right to choose. And I think that's some place where they feel like they have firm ground on. I think on the other side, it's going to be, okay, what's the economic record? Where are we at on inflation? Where are we at on immigration? And those are things I think the Republicans are trying to go after him on. So from our perspective, we're watching all of that from a political standpoint. But from a policy standpoint going forward, really it's about tariffs, taxes, regulation, those areas where we see, okay, where are these respective parties going to come down?
I am curious here about kind of what Walz actually adds to this ticket, Andy. There was a lot of speculation about Mark Kelly, obviously Shapiro from Pennsylvania, two states that, if the Democrats were to win it, would, to a certain degree, maybe potentially ensure an electoral college victory. Minnesota was never an issue. I mean, they voted for a Democratic president in pretty much every presidential election going back to Nixon. And I think prior to Nixon, almost every president going back to the 1950s. What does he bring to the table in terms of delivering electoral votes?
Well, I don't think he brings any direct electoral votes. And I'm really not even sure that Senator Kelly or even Governor Shapiro would guarantee electoral votes. They are the VP candidate. We ultimately vote on the presidential candidate. Now, would they help? Yes, they would help. And it's good to be from a state that's needed like Pennsylvania or Arizona. The case for Walz is that he's from Minnesota. It neighbors Wisconsin. So he speaks the same language. You could also say he can help with Michigan, those Midwest states. And I think the biggest states, by the way. Absolutely, yeah. Absolutely. Minnesota nice, right? And we can go the whole rest of the way. But I think with Walz, I think the thing that is appealing to him is that he's authentic, right? And that's and I think Manchin called him the real deal. So I think when you're looking at Walz, is what does he bring to the table as far as connecting with those voters in those regions? And I think there's a potential for that to happen.
That's interesting, and I guess an endorsement from Manchin. I guess anybody will take that, given that he seems to be kind of the perpetual political hater. But give us a sense here, because there's been a lot of memes about Walz and a lot of old videos cropping up of him just kind of being a dad out in the campaign trail when he was running for his own offices here. When you look at the combination of the two personalities here, and of course, all the positive media of attention right now that the Harris campaign is getting, how long do you think that can last? Because we know how brutal these media cycles can be. They love you today, but in 2 weeks, they'll find some reason to pick her and him apart and move on to, whoever the next big thing is.
So I think conventional wisdom is that honeymoon period can last through the convention. But I think once you're done with the convention, I think all the gloves are off with the press, and I think some of the things that the Trump campaign is going to be putting out there might start to stick. The question is, can they make sure they prevent it and get through and get the full honeymoon, or is it going to be interrupted? So I think they'll be pretty effective in their rollout and trying to get the positive messages for the ticket. But once you hit the fall, I think all the gloves are off, and we're going to have, all the weaknesses are going to be bare. And the question is, how do you navigate when the bullets are live fire?
Hey, Andy, before we let you go, in terms of sort of hedging the election at all and pricing in any kind of risk, is it too soon to do that?
It's never too soon to hedge in risk. It's never too soon to consider what's coming. I mean, I wouldn't not lock anything in at this point because, we're going through a process of continuously evaluating, okay, now that we have the two tickets, okay, what are all the forces at play that are going to determine their agendas going forward, and what's Congress going to look like? So as we get a better feel on that, we'll be able to kind of sense where we're going to be, because that's going to really determine how far one way they're going to swing or the other, and what the possibilities are.
All right, Andy, always great talking to you. Andy Blocker, Global Head of Public Policy and the Head of U.S. Government Affairs over at Invesco, a conversation about Kamala Harris and her new running mate, of course, the governor of Minnesota. We are expected to see both of them on stage together, the first joint appearance since the announcement here that Walz had been named as her running mate. You see the scene there, this over at Temple University in Philadelphia, Pennsylvania. You going?
No, I'm here with you.
Oh, okay. All right. Just checking. Don't go anywhere.
I'm not magic, but that would be cool if I could do that.
Okay.
Teleporting.
That would be cool, actually. That would be a lot to talk about here. We have a lot more to talk about as far as what's going on in the market on this turnaround Tuesday. Some stocks finding some new footing, including CrowdStrike. After weeks of negative investor sentiment, we're going to talk to one analyst that says now is the time to buy that dip. That's coming up next in our top calls on The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations, and we start off today with Lucid. Cantor Fitzgerald upgrading the EV maker to neutral from underweight. The analyst saying Lucid's new $1.5 billion capital raise with Saudi Arabia's public investment fund extends the company's cash runway through the end of 2025, also helping to solidify that longer-term commitment from the Saudis. The shares there up about 3% on the day. Next, Lumen Technologies, shaking off a sell recommendation with Citi upgrading to neutral. The telecom carrier's announcement that AI data centers had driven $5 billion worth of new business and $7 billion in potential sales was all the analysts needed to hear. The analyst saying Lumen will now have the flexibility to reduce its debt and improve its overall performance. The shares having a phenomenal day, up 86%, back up to around 481 and change. All right, and let's end on CrowdStrike, an upgrade today to outperform over at Piper Sandler. The analyst telling investors to, quote, opportunistically build positions at current levels. CrowdStrike has been in the doghouse since last month's global tech outage. While the analyst says it's still difficult to fully assess the impact, the risk reward following a 40% slump in the shares is too compelling to pass up. Those shares gaining about 5% on the day, and those are some of our top calls. We do want to stick with that last one on CrowdStrike. I'm pleased to say that the analyst behind that call joining us now, Rob Owens, co-head of technology research over at Piper Sandler. And Rob, it's easy to look at a 40% drop in the stock and say buy the dip here. Is there anything more than valuation that gives you the conviction to upgrade this stock?
Yeah, absolutely. I mean, CrowdStrike is one of the premier companies in cyber. We still think that cyber has a very solid backdrop from a demand perspective. We believe in trends around consolidation, and we feel that CrowdStrike is the best way to play those trends. Now, opportunistically, we think given the 40% drop in what's really been 2.5 weeks at this point, really opens the door for investors to step in and start to build positions at a very compelling level. In addition, I've been covering security now for a good 27 years before we even called it cybersecurity. And, these types of events, we have seen them before, not to this magnitude, but they are typically somewhat short-lived.
Yeah.
And we took relatively aggressive cuts to our estimates and looked at what a downside scenario might be. And we think shares are very compelling at this level. So we're upgrading to overweight. We're encouraging investors to take a look here.
So, but the one thing that is a little bit different, I think, from some of the past cybersecurity events is we're still now talking about the potential for compensation for Delta, maybe for Microsoft or whatever other companies feel that they need to be compensated. That's still unresolved and could take months, if not years, to sort through. How does that factor into your models?
It did factor in our models. And of course, there's been open letters from the lawyers back and forth. And we think the relative implications for CrowdStrike are minimal at this point. And I think it's been characterized in the single-digit $1 million type of range, despite Delta experiencing nearly $500 million in terms of damages. And it was Delta's own IT systems that couldn't get back up and running. If you look across the board, I don't think other people necessarily had some of these challenges. And so I think at the end of the day, the potential legal side of things will be relatively de minimis. And quite frankly, here's a company, by the way, that does $1 billion in free cash flow over the trailing 12 months. So I do think they have the wallet should anything happen. But at the end of the day, I think it's going to be relatively insignificant.
When you take a look at maybe customers, like if I'm Delta, why wouldn't I just go somewhere else? Like walk me through why that becomes not a risk.
Yeah, Alex, I think that's a fair question. And I think within our assumptions, we built in increased levels of churn. Granted, CrowdStrike has a 98% retention rate. It's one of the best in class companies, I would say, in the space. And we also built in some level of pricing compression relative to either renewals, expansion, net new business. And I do think you'll see some level of churn, but security is growing in importance. I mean, if we just look at this event, this was not a hack. This was a simple content update that went wrong, but it's showing how interconnected we are, how critical these systems are. And, you know, at the end of the day, I think it really speaks to the need for increased cybersecurity, because if this was truly a hack and these systems were down for months, all transportation would have ground to a halt. So will some customers be frustrated with CrowdStrike? Sure. But I think at the end of the day, excuse me, they are the preeminent solution in the space. They're one of the better companies, and they play to a lot of these positive trends that we've outlined. Yeah. So over the coming years, this is going to be a great equity to own.
And also, you know, Microsoft is in there too. Like there's some issues around Microsoft and the fix. Hey, Rob, just in terms of timing, how long do you think until investors get clarity on the actual amount and sort of get this behind them?
Yeah, this is going to take a bit. And of course, I think CEO George Kurtz, which has dealt with this in fantastic fashion, by the way, in terms of transparency and really being out in front of the problem. But he's going to go in front of Congress at some point. And given the political season, I'm sure we can all guess how that's going to go. But it's going to take some time to play out. But I think investors are getting more and more comfortable with the fact that it's probably not going to be that much from a litigation perspective. And if it is, CrowdStrike definitely has the balance sheet.
All right, Rob, we appreciate it. Thanks a lot. Rob Owens over at Piper Sandler joining us there. And speaking of, New York Times was reporting that Microsoft and Delta are now getting into it, that Microsoft's saying it was falsely blamed. Meanwhile, Microsoft is criticizing Delta for overstating the technology company's role in its costly disruption.
Yeah, I mean, this is kind of the overhang, right? At some point, this is still going to fall on CrowdStrike. How much they pay, how much they agree to pay, I guess really amounts to how much they fight back. But again, if you're an investor, you have to have this on your radar as a potential overhang.
Yeah, and to Rob's point, you know, it's going to be really difficult to sort of just like switch horses in mid-race at the end of the day.
Yeah.
Looking at the S&P here, we're up by 2%, but we are off the highs of the session. But nonetheless, it feels like turnaround Tuesday definitely stands. One company that's not standing is SunPower. That had declared bankruptcy today. So we're going to take a look at the solar industry, specifically with Sunnova. We're digesting that bankruptcy over with SunPower, but the Sunnova Energy CEO, John Berger, will be joining us. He'll talk about what it means for the broader solar industry, plus if we wrap in the elections, what it winds up meaning come 2025 for the industry. This is The Close on Bloomberg. All right, well, equities are holding onto their gains. One stock that is not shares with SunPower, one of the most prominent names in U.S. solar, filing for bankruptcy today, Romaine. And this is after a huge saga involving restructuring, management shakeup, the reduction of subsidies for solar in California that just really hammered their business.
Yeah, I wonder, it's kind of funny, too. I mean, when you look at, SunPower, we kind of knew that was a story that was unfolding for a while. Is that specific to SunPower, or is this sort of a broader representation of what's going on in the industry? Because I was looking at the stocks as a basket, at least. Like you could take like the TAN ETF over at Invesco. I mean, $121 was the high. And that was back in 2021. We're trading in the 30s now, and they've come nowhere close to rebounding back to those highs.
Yeah, and it's high rates overall, which is a negative. But also, if you get a rollback of the IRA of a new administration, does that also change the subsidy program? So we're going to delve into that with John Berger, Chairman and President and CEO of Sunnova. That company sells rooftop solar systems and batteries as well. He joins us from Houston. John, good to chat with you. What of the SunPower bankruptcy is endemic versus idiosyncratic?
Well, thanks for having me, Alex. It is idiosyncratic, or certainly there were specific issues with SunPower that, you know, in terms of it's no secret they had struggles with some of the accounting. I think the auditor resignation certainly kicked all this off. So a lot of what SunPower struggled with, troubled acquisitions and so forth, are really one-off. The equities in terms of the broader sector, including Sunnova's equity, has certainly been under pressure for the last few years. It is something that I think that as we look forward in the business, interest rate environment's definitely gotten more benign. I mean, the rate drop that we've seen over just the last few days has been tremendous. I think there's been some backup here today and some what I think is profit taking. But nonetheless, year over year, we're now starting to see not only rates sideways, but actually rates, in some cases, depending on where you are on the curve, actually have dropped materially, right? So in terms of interest rates, that's not really a factor. We've all adjusted our pricing to accommodate for that. Utilities have pushed up pricing tremendously because of interest rates, amongst many things that also drive their rate structure. And when you look at it quite simply, utility rates have gone up. Solar equipment, panels, batteries have crashed downwards, and that opens up a huge wedge for value for consumers. So business overall, as we said last week in earnings, is actually really good at this point. And some demise of some competitors, you can imagine that business has to go someplace.
Well, I was going to say, John, are you picking up market share? Who's calling you right now over the last 24 hours?
Well, we have seen a surge in business, as we said last week on our earnings call, that was pretty tremendous. I frankly have never seen anything like it and been in the business for a number of years. Was that in part due to SunPower's failure? They had announced the shut operations a couple of weeks or so ago. I mean, yes, some of that was. But again, we're also seeing the storm season is very active. Houston took a direct hit, as everybody knows, as an example of that. And so what we're seeing is utility reliability is dropping as well. So we're seeing a lot of consumer interest in coming in, saving on utility bills. There's been a lot more press about a ratepayer revolt starting in California, with those California rates jumping 85+% just in the last 3 or 4 years alone. And so you're seeing a lot of interest from consumers that's growing, despite what is, yes, higher rates than 3 years ago, but they're not that much higher. And utility rates, though, are much higher. So that's really what we feel like in terms of higher utility rates, lower utility reliability, is really giving consumers the first choice or only choice they have against the utilities, and that's driving a considerable amount of demand. As we go into a slower economy, you have to pay the power bill no matter what. And if it's cheaper with Sunnova or one of our competitors, you can imagine more people are seeking that cheap alternative out on that bill that they must pay.
What's the uptake, though, now, right, John? When we talk about new customers, those folks that haven't already adopted solar, I mean, what's the change in uptake versus, say, I don't know, a couple of years ago?
Well, we actually last week announced that we were stopping new dealers, at least for pausing, if you will, for a while. We'd never done that as a company because we'd seen such tremendous demand. And I think that'll level set itself out, and over a period of time, you have competition in a market, which is what we need. Consumers need that competition to the monopolies, to the utilities. But when you look at the cheaper and better equipment that's coming out at a rapid fashion from a lot of different suppliers, including folks like Enphase, SolarEdge, Tesla, and Generac, and so forth, there's a lot of new capabilities of managing load, of those solar panels do very well going through hurricanes even, and batteries do a great job. In many cases, we saw that even much better than generators through hurricanes here in Houston. So all of these attributes, again, utilities getting less reliable, more expensive, but the equipment's getting more reliable and more capable, and being able to deliver that kilowatt hour to that customer when they need it, when they want it, at a cheaper price. I'm
curious about your own internal goings-on here, John. When we talk about your earnings report last week, and you saw the big pop in the stock the day after, a lot of that seemed to be because investors were pleased with some of the commentary on cash generation. The idea that there has been, I don't know if we call it a shift to strategy, correct me if I'm wrong, but there is certainly a much more vocal focus on cash generation. Why?
Simply put, when you look at the capital markets became very difficult when rates did move up in the worst bond market in U.S. history, which even eclipsed the Civil War, which I thought was fairly noteworthy. But there's been a lot of focus on debt and debt servicing and ability to repay and so forth. And we made it very clear we don't take out debt that we don't believe that we can repay. And we had a plan here to generate the cash on a forward basis when we took out that debt a couple of years ago. We got plenty of runway on the corporate debt in terms of time. And our commitment was to investors was, hey, we're going to stockpile cash if we're not really being priced for growth, even though we're seeing plenty of growth, more growth than we can handle, as I just mentioned. But we're going to stockpile cash, and then we're going to go after the debt, pay the debt. That's the plan, and it's pretty simple and cut and dry, and that's what I think investors really appreciated.
Hey, John, before I let you go, let's talk politics for a second. So California is sort of paring back some of its subsidies for residential solar. And that's California. If we get a President Trump in the White House, what is your confidence level that the IRA and all the solar subsidies stay?
Well, those are two separate things, Alex. I mean, one in California, I wouldn't call what they call net metering, especially now with batteries, as a subsidy. Really, there's a lot of value that having all these solar systems and batteries and load management spread across the state of California behind the meter can really add value to the system, and there's a lot of value there. The problem is the utilities just have the governor's office and the Public Utility Commission really with a stranglehold and trying to just continue to drive up rates. Simply look again at the ratepayer revolt and the rates that are being driven up since they so-called got rid of net metering. So that's one issue on the political side. We are looking for open markets. Candidly, like Texas, has been much more of an open market for us, and we've seen a lot more growth there. On the other side, the IRA, look, I think this is a bipartisan, bill at the end of the day. It's working in terms of driving manufacturing and creating U.S. jobs here. And I don't think that no matter who gets in the White House is really going to roll that back because it's been so successful. The other thing is you looked at the weak jobs report, which really took the market for a tailspin, as we all know, over the last couple of days. The last thing I think that whoever wins the presidency is going to want to do is do something that actually drops or degrades or lessens job growth and maybe even it leads to more layoffs. I just don't think that's good public policy, regardless of whether a Democrat or Republican. And candidly, this is an industry in terms of the new energy industry that we need to own as a country, and there's bipartisan support for that as well. So I think that we're largely speaking a lot of politics, and at the end of the day, I think the IRA is going to be largely intact, regardless of who wins the White House here in 90 days or so.
All right, John, going to have to leave it there. Appreciate you taking time for us. John Berger, Chairman, President, and CEO over at Sunnova Energy. Those shares down a little bit here today, kind of bucking the trend onto the upside. Maybe that's the drag down from that bankruptcy out of its competitor, SunPower here. But keeping an eye right now on a lot of the electric vehicle stocks here, seeing a little bit more of an appetite for those shares. Lucid Group up about 3% here on the day. We mentioned earlier, Alex, of course, that investment by the Saudi fund, $1.5 billion here. And we're going to get some earnings results later tonight out of Rivian, which is also seeing a little bit of a rebound here. A lot of people were concerned about its future, but it's managed to raise some money and now maybe has some life ahead of it as it tries to build up its base of customers.
I just wonder how much cushion that gives them, right? So you have Lucid and Rivian. Clearly they need cash infusion, but they have all the cool technology and the cars. So how do you bridge that gap? How long is that bridge?
Yeah, and it's interesting though too. You see a lot of parallels with Tesla, right? Tesla went through the same thing. They had these cool cars, but they were burning cash. They were losing a lot of money. Everyone was like, this company's just going to circle the drain at some point, and obviously through a lot of creativity by certain people, they managed to strive and survive. And I think a lot of people are looking at Lucid and Rivian and saying, can they replicate what Tesla did?
Yeah.
All right, coming up, we're going to take a look at another big mover here on the day, this time to the upside, and that is Kenvue, the spinoff of Johnson & Johnson, rallying more than 14% here on the day. This is the company behind Tylenol, Neutrogena, a lot of the stuff you see on the store shelves at your local drugstore, beating sales estimates and bucking a trend of weakness from its competitors. That's our stock of the hour, and it's up next on The Close on Bloomberg. All right, well, it was one of the biggest IPOs of 2023, Kenvue, the spinoff from Johnson & Johnson. The shares rallying today, up about 14%. This on the back of a report that sales topped estimates in the most recent quarter, bucking a trend among its peers. Abigail Doolittle joining us now for more on this stock. We should point out at $20.74, still actually trading below its $22 IPO price. Now, this is the company that makes Tylenol, Neutrogena. Basically, you walk into a CVS, Duane Reade, all that stuff you shoot in the shelf is there. So what's going on here?
So it's really a case of bad expectations, because in the quarter, in terms of the quarter that they reported, yes, they did beat sales and earnings, but earnings relatively paltry, 31 cents. Sales healthy, $4 billion. But the growth of 1.5%, it was less than sequentially 1.9%. However, that beat the decline, the expectation for a decline of 0.7%. Margin shrunk on brand investment. They reiterated the full year guide. But when you put all that together, should that equal a 14% pop and the best day since that IPO that you were talking about? So again, it goes back to those bad expectations. Procter & Gamble, they put up a bad quarter. They had strong volume but weak pricing. So I think that folks are pretty relieved that this quarter was not worse. The company also said that they've not made meaningful share in terms of their private label brands and that consumers are making trade-offs. He did say they're spending on health, though.
Okay. Well, that's interesting. The private label, you'd think would be doing better if people are feeling the pinch when they trade down to private label.
But to your point, like, you know, skincare, for example, like there's so many competitors out there now, and they're all in some ways price competitive.
Yes.
That's also maybe an issue going on there as well.
I think that is a case. Also, Neutrogena has been around for so long, and these new brands, they have fun packaging.
Neutrogena, I used to use the T-gel on my hair. I haven't
oh my
bought
God, I used to use the T-gel.
All
right, Abigail, thanks a lot. I appreciate it. All right, well, coming up, we're going to count you down to the closing bells. We're at 15 minutes away. We are off the highs of the session. S&P up 1.7%. Paul Christopher, Wells Fargo, joins us next.
I do think that we're getting a correction here after a very strong run in the markets, and that might be healthy. In terms of your question about a recession, our economists have upped their chance of a recession to 25% from 15%. You know, all of that I think is a little lower than the broad consensus. My view is that the best chance as we look forward is, you know, the economy will chug along and we probably won't see a recession, but the possibility is not zero. It's never zero.
CEO of Goldman Sachs here, David Solomon, giving us his thoughts on economic conditions. Are you preparing for a recession?
Oh, gosh, I don't know. I'm not qualified.
I don't know. It's interesting because, well, you were here. I was gone the last couple of sessions here. But, I mean, it seems that there's a market that is coming to terms with a potentially softer economy than maybe what they have priced in before. But are they pricing in a recession?
Well, if you take a look at how steep the curve disinverted, some say that that is a sign of a recession. But then now we're giving that back a little bit. I'm just debating whether or not you trust this rally today. I was calling it a dead cat bounce before on radio. It's not a dead cat bounce because it has to be it's still an uptrend.
Alex.
I know.
Leave the cats alone.
But you know, I just feel like you have so much systemic funds still with positions to sell on that front. The carry trade, what JP Morgan was saying, it's only 60% done.
Yeah.
I mean, there could be more shoes to drop here.
Yeah, but then you had the data that's saying that a lot of the dip buying was by institutions and that the people sitting on the sidelines right now, at least in their view, are primarily on the retail side here. It'll be interesting to see how all this shakes out. Maybe we'll get some insights out of our next guest as we march closer to those closing bells. Just about 8 minutes to go. Paul Christopher joining us right now, Head of Global Investment Strategy at the Wells Fargo Investment Institute. What did you make of that 3-day sell-off, Paul? Obviously, the most significant 3-day sell-off we've had in quite some time. Was that a real flip-flop in investor sentiment, or do you think that will prove to be more of a just kind of a blip on the way to wherever the heck we were going before?
Well, thanks. It's great to be back with you. I would see it as part of a sequence that started back in July when we got that inflation reading, and after that, interest rates fell and interest rate futures priced in 100% chance of a Fed rate cut in September. And then when you get to the beginning of this month, just last week, so to your question, all of a sudden then you see very weak manufacturing PMI and an employment report that misses, and people are saying, whoa, inflation's falling faster and the economy's slowing faster than what we had thought, and so we maybe better catch up with that. The real risk is that the economy slows here. I don't think we have a recession, but the risk is that we slow to below 2% for a time in the back half of this year, back quarter of this year. And then we're vulnerable to a shock. It could be elections. It could be geopolitics. It could be liquidity. Think about this. The Treasury is soon going to have to start hoarding cash instead of spending it like they do in an election year. Why? Because you've got debt ceiling coming up.
I am curious, though, Paul, when we talk about the expectations for the Fed and what that Fed mechanism can do, I was looking at the outlook from Wells Fargo for rates. If I get this right, correct me if I'm wrong, 425 to 450, that's a year-end target for the federal funds rate. That would be a full percentage point below where we are right now.
Yeah, that's right. That includes a 50-point cut probably in September and then 2 quarter-point cuts. The Fed may be wanting to weight the front end of that a little bit more just in case they're a little bit behind.
So, Paul, do you buy stocks into that or do you sell stocks into that?
Oh, we're buying. Look, what we published today was taking our whole positioning back to neutral. We had been overweight bonds and underweight stocks. We used the opportunity of the sell-off and the big drop in rates to take money out of fixed income, put it into equities. We like large caps here. We like industrials, materials, energy. We like comm services now. We added that, and we like financials, even though they've not done well lately on the decline on rates. But we think there is a pivot coming in this economy later this year, early 25. So we want to position for that now.
But some of what you were mentioning are also cyclical names. So if we do get that turn in the economy and a 50 basis point cut from the Fed, that would imply that things aren't great. So do you just hold on to those stocks and wait?
Well, the Fed was always going to cut rates, even if the economy just slowed back down to the low 2s. So we don't regard this as some sort of a danger sign. The Fed doesn't want to see us go maybe below 2% because, like that bicycle on the sidewalk, once you slow by enough, then you hit a crack, you hit a hole, you hit an uneven set of sidewalk slabs, and all of a sudden you're falling off your bike. So you don't want to expose yourself to those shocks, and we think that's why the Fed would cut a little bit more this year than we had previously thought.
I love the bicycle analogy, Paul, as someone who falls off his bike pretty frequently here. I'm definitely feeling that. When we talk about whether people are still going to be feeling that cyclical trade, that big sort of rebound that we had seen over the last few weeks in small caps, given the shift in sentiment about economic conditions, do you think there's life left in that trade?
No, there isn't. And if you go back and think about what I said a minute ago, this whole sequence started back in July with that CPI report, and a lot of that carry trade had not yet gone away, and that was just liquidity, we think, rushing into small caps because it looked like the cheapest deal on the street. So now that the carry trade is pulling back, you're going to see a lot of that money go back away from what was maybe a chasing low prices that only got lower.
Yeah, Paul, I'm really curious as to how much you think that influenced what we saw in the equity market. Like, I'm going to borrow yen and buy tech stocks, or even like a derivative play of that. Was that real?
Yes, it is very real. I mean, think about a Japanese investor, a pension fund, insurance company. Maybe they were in U.S. stocks chasing as well, and then they see this news out of the Fed that the Fed's might going to cut interest rates, and then you see the weak data, and you think, I better get into bonds. So you rush into bonds and out of stocks, and then you're going to hedge. And because interest rates have come down so much, it's really cheap to hedge. So you're going to hedge everything. That's going to push yen stronger, dollar weaker. It's going to put stocks down and bond yields down too. So this is probably not the only carry trade, not the only source of liquidity, but it's an important one. And in terms of flows, it's the one that has turned on a dime.
Paul, always a wonderful conversation. Always great to get your insights. Paul Christopher, Head of Global Investment Strategy at the Wells Fargo Investment Institute, here on this turnaround Tuesday. Alex, a turnaround that's looking a little weak as we get closer to the close, still holding on to some sizable gains, up about 1% across the board. But we were over 2% on most of the major indices just maybe about 2 hours ago.
We're definitely fading in a little bit, so the next few minutes is actually going to be really interesting. And we get earnings also. Instacart, Airbnb, Rivian, TripAdvisor. What else am I missing in there? This should be pretty fun over the next 20 minutes.
Yeah, we're going to get a nice cross-section, I guess, if you will, about a lot of different areas of the economy. And it raises the question as to whether any of those are going to move the needle. Do they change sentiment, given that they're not quite the behemoths that we had over the last 2 weeks?
I mean, Booking didn't do so well, right?
Yeah.
So I think the read through to Airbnb. But yes, that feels very idiosyncratic versus, or maybe a slight macro read rather than something more or bigger, like an Apple or an Amazon.
And not a big economic data points this week either here. So it'll be kind of interesting how this market kind of shifts, not having those economic catalysts and maybe not the earnings catalysts either as we move closer to those closing bells here on this Tuesday afternoon. Sit tight. Full market coverage coming up right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, here to help take you through the closing bell. It's a global simulcast starting now. Scarlet Fu joining us in the television studio. Carol Masser in the radio booth. Matt Miller alongside Carol filling in today for Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, including our partnership with YouTube.
Yeah.
Carol, did you miss me?
Yeah, as a matter of fact, Matt and I were just saying, since you were out on Friday and Monday, that the four of us are just going to pepper you with questions about what you missed and try and get your analysis.
Did I miss a lot?
You missed a little bit. Having said that, we're just a few minutes away from the close on this Tuesday, and we're seeing some selling guys into the close. We're still green across the board, but we're definitely off our best levels of the session.
There is still a lot of green. You have the lift of NVIDIA, and these, for the most part, the mega cap tech stocks are up. There are a few decliners, fortunately for me, because that is my job, so I'll give those to you in a little bit. But even the SOX index is up. So chip makers in general are rising as well, and that's good for this market after the drops that we saw yesterday.
Yeah, and let's not forget that JP Morgan said that this unwind of the carry trade is only about halfway through, maybe a little bit over halfway through. So we might have gotten a little bit of a reprieve today, but that's fading in the afternoon. And as we get towards the weekend, closer to Friday, we might start to see volatility pick up again.
You're jumping ahead of yourself.
I know. Yeah, she's moving ahead. But, Goldman
Tuesday.
Sachs did say about hedge funds kind of getting in and buying the dip, but there's still so much systemic funds out there. You have to wonder if they have to sell that trend, and that just means more downside for equities.
Well, still a rebound here on this turnaround Tuesday, though a bit more caution as we get closer to the bells. When we started the show about an hour ago, we had more than 450 stocks in the green, only about 400 of those stocks going to finish there as well, but the aggregate numbers, they're still looking good. Up about 280 points on the Dow Jones Industrial Average, or about 0.8%. A 1% gain on the S&P 500, and a similar gain for the NASDAQ Composite, as well as the NASDAQ 100. Almost equal gains, at least on a percentage basis. And believe it or not, your outperformer on the day was the Russell 2000. Modest outperformance, 1.2% here on the day.
Yeah, and definitely off its earlier gain of about 2.3%. I'm going to go back to the big caps. You mentioned it, Romaine, that the S&P 500, still most names higher today, 394 to the upside. Scarlett, about 108 losing ground.
What's your favorite one, Carol?
Uber, maybe.
All right, let's take a look at the sector performances. Yesterday, we had the equivalent of a cherry pie. I think that's what Matt called it. Today, it's a pesto pie because everything's green. There are a few red slices, and you have to dig pretty deep. Tech, hardware, and equipment down about 0.5%. Food, beverage, and tobacco off by 0.1%. But by 11 sectors, each one of them have gained at least 1/3%, with real estate the best performer.
All right, I would not eat a pesto pie. I'm
Really?
just going to, yeah, I don't think I
What?
would. No. Like a clam, though. White clam pie, that's pretty good.
A white pie is a
What's
white
the
pizza is
problem?
good for you. Okay, got it.
All right, let's get to some of the individual gainers. Lucid Man, at its highs, up more than 13%, finishing the day with about a 3% gain. Matt was talking about this as we broke it yesterday. This story, this company getting a $1.5 billion lifeline, a cash infusion from one of its biggest investors, an affiliate of Saudi Arabia's public investment fund. So that definitely helped that one out. The company also reiterated its annual forecast, so up about 3%.
I spoke with the CEO this morning.
And what did he say?
Peter Rawlinson.
And what did he say?
He said they're making amazing vehicles, and pretty soon people are going to start buying a lot more of them.
I bet he's feeling a lot better with that cash infusion. All right, Palantir up more than 10% in today's session. The company reported second quarter results. It did beat expectations. They raised their annual outlook, citing continuing demand for AI software. Uber, I mentioned that was, I think, my favorite gainer in the S&P, number 2 gainer in the S&P 500, up just shy of 11% today. Company reported better than expected orders in the second quarter, underscoring the continued strength and demand for rideshare. Upbeat, so investors liked it. And I just want to mention one more. Kenvue, I know, I'm going for 4, up almost 5% in today's session. Top in the S&P, they own Tylenol, they own Neutrogena brands, jumping after reporting sales that topped estimates and bucking a trend that we've seen from some others in that consumer space. Take it away, guys.
All right, just to break some earnings here, TripAdvisor coming out, their second quarter adjusted earnings coming in 39 cents a share. That definitely looks to be beat. I am looking at its core revenue coming in at $250 million. It looks like that is slightly below estimates, but overall their revenue is also below estimates, coming in about $497 million.
Okay, we also have Airbnb results coming out. Let's give you the numbers for the quarter that ended. Second quarter revenue, $2.75 billion, slightly higher than what was anticipated. Second quarter gross booking value, $21.2 billion, a little bit shy of the analyst consensus of $21.23. But here's the outlook, which is what's driving the stock lower in after-hours trading. It sees third quarter revenue of $3.67 billion to $3.73 billion. Analysts were looking for, on average, $3.84 billion. So that missed revenue forecast really pulling the stock lower by about 9% right now.
One of the biggest decliners in after-hours trading, one of the biggest gainers is Reddit. The shares were up about 14% now, up about 8% on the back of their earnings. Daily active users in the most recent quarter, a beat, 91.2 million. The street was looking for roughly about 85. Revenue also beating at $281 million. Street was looking for 253. The company giving a forecast for the full year here that also beats estimates across the board, 290 to 310 million. That is the revenue forecast. The street was looking for 282 and change. Adjusted EBITDA, 40 million to 60 million. Matt, that high end of that range is almost double the average of street estimates.
All right, let's take a look at Airbnb again, because the forecast for the revenue missed the third quarter. And of course, this is what matters, right? It's about the outlook. People don't watch this show or listen to it on radio for the exact earnings numbers going out for significant digits. They just want to know, is it up or down? So it's a down arrow story with Airbnb. If the forecast is down, you can expect the shares to fall in the aftermarket and for a rough open tomorrow.
Yeah, and what's interesting too, just looking, free cash flow, $1 billion, that's up about 16% year over year. Gross bookings, value per nights and experience, they were up about 2%. It's interesting. They're also saying they anticipate, in terms of some of the commentary coming from the company, that the implied take rate in the third quarter of this year will be higher year over year, primarily due to the timing of bookings and cross-currency transaction fees. So they're getting into some of the kind of just a little bit more color in terms of the earnings. But again, down about 12% here. And that's building off a 4% down for 2024.
Yeah, I'm just looking, trying to get some read on capital expenditures, because they are investing. They talk about how they're investing in under-penetrated markets, and definite questions on terms of how much they're investing into those new markets. I was trying to find a read on that, but I didn't get an actual number. But they're trying to roll out different areas and leveraging global expansion playbook, etc. I want to get that number.
Yeah, I don't have a number here for you, but just some color on that. Latin America and Asia continue to be the fastest growing regions for Airbnb. It's seeing shorter booking lead times globally, and specifically when it comes to the U.S., signs of slowing demand from U.S. guests. And as a result, it's expecting sequential moderation of growth on the metric of nights and experiences booked for this quarter, for the third quarter. So again, going back to what Matt was saying, a big down arrow here for the third quarter.
Yeah, we get a down arrow for Rivian as well. The company coming out with a loss per share that's a lot worse than the street was expecting, or a lot worse than they had year over year. 127 last year, 146 this year is the loss. If you adjust that, then they only lost 113 per share compared to the estimate for 120. So that maybe looks a little better, and that revenue was bang in line with estimates at 1.16 billion. Again, it's all about what they lost compared to what was expected. It looks like they're kind of in the ballpark. If you look at the total dollar figure, $860 million in the quarter is what they lost. 892 is what we were looking for. This is a company that burns roughly $900 million a quarter. So they need to turn that around.
Instacart, of course, the company that operates as Maple Bear, out with earnings as well. The shares down here in after hours trading despite a beat on both the top and bottom line. Gross profit in the quarter rising 18% to about $623 million. EPS also coming in above estimates, and gross transaction value at about $8.2 billion. The street was looking for $8.1. The forecast for the third quarter, the company says that it sees gross transaction value at $8.1 to $8.25 billion. The low end of that range is right on the nose of the average of street estimates. Nevertheless, shares are oscillating between gains and losses right now.
Yeah, interesting. I mean, this one's had quite a run this year. It's up more than 30% here in 2024, and you're seeing it kind of bounce around, as you said, Romaine. But right now, to the upside, more than 3%. All right, guys, that's a wrap. Another drop of earnings. We'll continue to track them into the aftermarket and, of course, into the Wednesday trade. That's a wrap. Our cross-platform radio, TV, YouTube, and Bloomberg Originals. Alex heading out. Tim and I are, not Tim, Matt, sorry.
That's okay. I don't mind. I'll be Tim.
Back to radio and YouTube.
I could be a decade younger.
Scarlett will remain, of course, continuing on TV. Folks, we will see you again, same time, same place, for our cross-platform coverage.
And our coverage continues here on Bloomberg Television. A slew of earnings coming out here after the bell. Full analysis and a full breakdown of everything that just happened when we come back after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Not just green on your dress, Scarlett, but green on the screen today. A big rebound here on this turnaround Tuesday, coming off those 3 big days of losses in the market. Of course, most of those losses are far from being recouped, but a lot of folks will take it. An S&P and a NASDAQ gaining about 1% here on the day. Similar moves for the Russell and Dow. But take a look at the VIX. We went basically from what was the biggest surge in the VIX going back to 1990 to today, the biggest drop in the VIX going back to at least 1990. The inversion of the yield curve, that continues, though we did have that brief uninversion yesterday, Scarlett. But overall here, the picture being painted seems to suggest that for whatever rattled markets over the previous 3 days, some people are comfortable coming back into this market.
At least for now. We'll see how it, of course, goes on. And a lot of it depends on earnings. And that is giving some stocks a specific boost. Let's start with Kenvue, up almost 15%, the best performer in the S&P 500. The consumer goods company's sales unexpectedly rose last quarter. Remember, it sells things like Listerine and Tylenol. That makes it a clear standout from other consumer goods companies like P&G, for instance, which reported disappointing revenue. The weakness here, of course, at Kenvue was its skincare line because it also makes Neutrogena because of lots of competition. Uber also reported results. The stock is up 11%. Second quarter gross bookings. That includes ride hails, delivery orders, and driver and merchant earnings, but not tips. That came in higher than expected. The CEO, Dara Khosrowshahi, says that we are not seeing any softness or trading down across any of their income cohorts. So you can see that stock also helping Lyft get a boost there. Lyft, of course, reporting earnings tomorrow morning. Now, our top story this hour is big media's pricing power. Disney announcing plans to raise prices on its individual streaming service and bundles by double-digit percentages following recent hikes from Netflix, Comcast Peacock, and Warner Brothers Discovery's Max. Now, the increase lifted shares of Disney today, and it will feed into its outlook when the company reports earnings tomorrow, along with WBD. Speaking of which, we'll be sitting down with the showrunners of HBO's high finance drama Industry later this hour.
All right, but we need to get back, of course, to the market moves on the day here. A big turnaround from what we saw the previous 3 sessions, but not everybody's buying into it. Dennis DeBusschere is the president and chief market strategist over at 22V Research. He wrote in a note that our sense is the market will stay in a violently flat regime, at least until the breadth of data can allay recession fears. Pleased to say that Dennis joins us now here on the big program. And Dennis, there are a lot of people looking at some of these recession fears and saying they're overblown. But when you look at the data, is there enough confidence to push back on those fears? And by pushing back, I mean actually putting money back into this market.
Not yet, in our opinion. So our base case is that we do avoid a recession, but recessions are such tail events and have such a large impact on earnings that you're better off waiting for some confidence that you actually are going to avoid a recession before you really lean into the idea that you should be putting on a non-recessionary trade. So getting very overweight cyclicals relative to defensives. And we're just not going to have information that basically denies that recession view probably for a few more weeks. The main one being claims, because as we know, post-payroll, the main risk in markets was some unwind in the labor market. And if we are going through that, the claims data should signal that that is actually the case. And we're probably going to need a few weeks, maybe longer, of claims data that's stable, along with broader activity data that's stable, before you can really lean into the idea that we're going to avoid a recession. Ultimately, we think that's the call, but I don't think it's going to pay to front run it right now, given how much of a negative tail to earnings you have if, in fact, the economy gets into a negative feedback loop.
There's been a lot of people sort of wringing their hands over whether the Fed should have done something at the last meeting, whether they should do something before we get to that September 18th decision. But I sort of wonder here, Dennis, as to what the Fed would really be reacting to. Do you think that they're more concerned about some of that softness in economic conditions, which we should point out helps their inflation battle, or are they going to be more concerned about the potential tightening of financial conditions, which last time I checked aren't necessarily all that tight?
Yeah, I think what you're going to see from the Fed is more of insurance cuts, right? So you have an increase in the unemployment rate to 4.3%. You have inflation that's coming down. They did have some level of, they do have, I should say, a level of restriction that seems to be pretty tight right now. So they need to reduce that. Some people are calling that a reversal of the insurance hikes, right? So they went above what they thought to make sure that inflation expectations never became unmoored. And now you could reduce that very quickly in a risk management framework. So you go 50 in September, maybe another 50 in November. And I think that's perfectly plausible and reasonable, quickly getting some cuts in to risk manage away from a unwinding in the labor market. Which gets back to the earlier question. No, there's no intermediate cut unless something's wrong with the plumbing in the financial system. I mean, we're not in a recession right now. It is possible that the labor market is going through an unwind. The claims data, again, will prove or disprove that thesis. But there's nothing in the data that suggests that all of a sudden, because payroll growth did not grow as much as we thought, because labor supply is increasing so much, that they should be cutting rates right now.
So you use the word unwind to describe the labor market, but I mean, what I've been hearing is that people use the word unwind of the carry trade, where people were borrowing in yen to buy higher yielding assets. And according to JP Morgan, the unwinding of that carry trade is only about halfway through, maybe 60% of the way through. If that means that we've still got more to go, what does this next phase look like? Is it going to be dependent on the yen's moves and whatever commentary may come out of the BOJ?
Yeah, I think if the carry trade were to continue to unwind and you're injecting, as a result, as you know, significant consistent currency volatility, interest rate volatility, and the known unknown of what could go wrong or where that could extend beyond just, say, Japan carry trades, related carry trades, then you will end up being in a very volatile, violently flat range, right? Mm-hmm. On the one hand, it is not clear that there's a systemic issue, and there appears to not be a systemic issue related to carry trade unwinds. On the other hand, we don't really know. I mean, there's something else that can float to the surface. Right. So as long as you're going through that process, you'll have uncertainty that creates a lot of volatility from day to day.
Okay, so in that uncertainty, what does defensive positioning look like then? I guess this goes back to what Romain was asking earlier. What counts as a reliable safety play right now?
Low volatility in defensive sectors, right? So you want low volatility stocks, if you think about it from a factor point of view, and then simplify from a sector point of view, it's defensive stocks, which is utilities, pharma, staples, probably eventually big cap tech, although they might have specific AI related issues that people are grappling with. But I would say just defensive, higher quality securities, like I mentioned, would be the place where you're going to hide. That's what's done very well, particularly on the defensive sectors, staples, utilities, and pharma.
All right, good stuff. Dennis, really appreciate your joining us. Dennis DeBusschere is president and chief market strategist at 22V Research. There's a really good comment in our big take story today that really caught my eye, Romain, and it was about how investor technology during a rout tends to begin with jitters on Thursday and then hedging on Friday and all-out selling on Monday, which then sets us up for this turnaround on Tuesday. Okay, yeah, I saw that too, and I guess, historically, I guess that's true. Bloomberg crunched the numbers. I think they said, 582 times we've had this sort of Thursday, pattern. Friday, Monday pattern, and then on Tuesday you do get that rebound here. But it gets to the idea of what Dennis and really all our guests have been talking about today is how much conviction is there behind this? Is this a one-day thing, or are you going to really see the buying continue? Yeah, it definitely feels fragile given what we saw in the final hour of trading. Yeah. A little bit of a swoon into the closing bell. Yeah, the good thing is, though, too, and I was kind of looking at the valuations. There are some stocks that are really good fundamental stocks that really got hit hard. Yeah. We're talking that are down maybe 15, 20% from their recent highs here. And if you're looking for value, long-term value, I could see why some people would come in for those types of things. Yeah, but they might want to wait until this wave of selling really shows Never its hand. Wait, Scarlett. That's not the advice. Risk of waiting, the risk of timing the market, right? Yeah. All right, we've got a lot more to come. A lot of it, of course, will depend on earnings, and some of the earnings that we got this afternoon, not looking great. You can see right now, TripAdvisor and Airbnb, some of those travel names, getting hit right now.
Yeah, I just got off a plane recently.
And was it crowded?
Travel. Well, first of all, I was lucky just to be on a plane. I was like in one of the little puddle jumpers.
Oh.
You know.
Where are you coming from?
Chicago. That's all I could do to
You're
get
not
out of
flying
there.
full planes from Chicago?
Apparently not. I don't know. Thanks, American.
This is Bloomberg. All right, more earnings rolling in, this time from Supermicro. The quarter that just ended, the fiscal fourth quarter, a miss on all fronts, whether you're looking at adjusted gross margin, net sales, or adjusted EPS. But you can see the stock is surging right now, up 17%, because its 2025 net sales is a range from $26 billion to $30 billion, and analysts were looking on average for 23.6. So the midpoint of Supermicro's range is higher than the consensus estimate. And this is a stock that, Romain, is up 117% so far this year for the best performance in the S&P 500 on those AI connections.
Yeah, this was kind of considered kind of that alternative AI play that if you were concerned about NVIDIA's valuation, maybe Supermicro might have some juice for you. The numbers don't look incredible, but I guess investors pleased with it. 14%, that's your biggest gainer in after hours trading among the big and large cap names. The biggest decliners, Trex and Airbnb, some notable moves out there as well from Reddit, TripAdvisor, and Instacart. A wave of earnings crossing the wire here in after hours trading. Let's get you a roundup on some of those names, and we're going to start things with Jess Menton, Abigail Doolittle, and Bailey Lipschultz. Here, let's start off with Reddit. Bailey.
Yeah, Romain, technically they sell themselves as an AI beneficiary, though not to the degree of Supermicro, beating expectations across the board on the second quarter, providing third quarter revenue guidance at the bottom of the range was well above what Wall Street was looking for. When you look at it, though, you say, why is the stock down 2.5%? Still up 60% from its IPO price earlier in March. And the big thing to keep an eye on, lockup expiration on Friday. So those executive insiders, management team, and longtime investors are going to be able to sell shares on Friday. So that's something investors have been positioning for. Definitely not the 18% move that we saw pricing in from options. But again, when you're up 60%, even with the pullback in broader tech over the last few weeks, the stock is down, again, modestly 2.5%, but still at one point was up 10%. So certainly going to be keeping an eye on what could be a choppy session, again, with all eyes on that lockup on Friday. Though, Jess, I want to go from one recent IPO to another IPO recently, Instacart.
That's right. So I'm looking at food delivery companies, and they've actually been on a tear, especially with their earnings the last week or so. So looking after the bell here, if you are looking at Instacart, owned by Maple Bear, up almost 8% in after hours trading here. If you looked at its outlook as well as its sales growth, did beat expectations. Also, if you want to look at gross value, when you are looking at those transaction type volumes for the third quarter, actually coming around 8.1 billion to 8.25 billion. So that's a key forward looking metric. So you're seeing that supported. Also on the earnings call, you want to see more details about how they're trying to expand more international beyond just their food delivery businesses, because they've been more reliant on more of the high kind of gross margin and also enterprise type business that takes up about a third of their revenue when you are looking annually. So that's something really key to look at this call. But again, if you look at Uber, actually just posted its best day since February on the back of really strong earnings results. And then DoorDash last week actually came out with results, one of its best in about 9 months when you're looking at that stock price from last week. But Abigail, what are you looking at?
Well, I'm looking at the state of travel and taking a look at the shares of TripAdvisor. It's not going so well, at least from the perspective of investors, down about 8% here in the post-market, although now going to Unch, and it was all over the map before coming on air, now down 8% again. They beat on the bottom line, putting up 39 cents versus consensus of 37 cents, but relative to revenue, there was a miss. They put up 497 million versus the estimate of about 505 million. But what I would really like to point out, Scarlett, they break it down in all sorts of categories: branded hotels, advertising and media revenue, and other revenue. Misses across the board, but there's one that really stands out, and that is experiences and dining revenue. $48 million was earned there. That's down 4% year over year, but versus the estimate, I don't know if this is a bad print here, but it would help to explain why the stock is plunging, of $238.6 million. Now, that's comprised of just two estimates, but it's consistent with what Amex said, weakness in experiences and dining.
Yeah, so the state of travel not good right now, according to TripAdvisors. Abigail, thank you so much, along with Jess Menton and Bailey Lipschultz. We're going to stick with the state of travel and bring in Airbnb Airbnb, which of course is adjacent to that. The shares are tumbling in after-hours trading, losing more than 13%. Bloomberg's Natalie Lung has been following the company. And Natalie, this really comes on the heels of a disappointing outlook and what it says about weakness from the U.S. consumer specifically.
Right, and so today Airbnb reported weaker than expected outlooks, and it specifically pointed to weakness in the U.S. consumer, and that sort of underscores some of the sentiment that investors have already been worried about from the travel sector, especially last week with Booking noting some weakness in Europe as well. So whether this is a global phenomenon, we'll have to see.
It's interesting they talk about in the release of trying to come up with new products or services, I guess, to augment maybe some of the softness they're seeing. What exactly would that be?
Yeah, so that's very interesting development that we're tracking as well. They mentioned marketplace for guests to maybe order luxury services, like you might have a personal chef in your list during your stay, or a personal masseuse. So they want to enable more of that, enhancing those experiences for guests.
So like a hotel. Okay. All right, Natalie Lung covers this for us. Airbnb, one of the biggest decliners here in after-hours trading, down about 13%. And I feel like the writing was kind of on the wall. There was so much anecdotal evidence about people pulling back on travel. There was a lot of anecdotal evidence about people being upset with some of the fees that Airbnb was charging, and the idea that they were now more expensive than a lot of hotels.
Yeah, when you go on Airbnb, the app, there's a price, and then once you would tally everything up, it becomes a totally different price with the $100 cleaning fees and everything else that gets added on.
Yeah, even if you didn't really make a mess or anything like that. All right, when we come back, we're going to take a look back at this day in history, the day that Apple and Microsoft grudgingly buried the hatchet. And here's a question before we go to break. What was Apple's shrinking share of the PC market in '97?
Small.
All right, it was on this day, August 6, 1997, when Apple stunned investors by announcing that its industry archenemy, Microsoft, would take a $150 million stake in what was then a money-losing maker of Mac computers. Now, Steve Jobs, whose disdain for Bill Gates was legendary, said at the time that we, quote, have to let go of the notion that for Apple to win, Microsoft has to lose. Now, while the investment represented just about 5% of Apple's stock, the psychological boost was enormous. You have to understand what was going on around the time. Steve Jobs had effectively been forced out of Apple back in '85 and then spent a decade in exile building Pixar as well as Next Computer. But it was in July 1997 that he was coaxed back to Apple, this after the ouster of Gil Amelio, who had been the third Apple CEO in just 4 years, a 4-year stretch where Apple's stock price had plunged 70%. And its industry market share, it had slipped to 3.5% of PC shipments. That was down from 8% just about a year and a half prior. Now, the Mac World in August would be the first major public appearance by Jobs since he returned to the company he founded. Expectations, they were high, especially for a fan base of cultish Mac users. Jobs, as expected, was greeted with raucous cheers by the 2,000 people in the audience. But about 20 minutes into his speech, those cheers turned to jeers when the video screen on stage flashed the logo from Microsoft as Jobs talked about new partnerships. Jobs continued, though, announcing that $150 million investment. Audible gasp swept through the crowd. And then Bill Gates appeared via satellite link on the screen, and the audience erupted. And that went on for quite a while before Bill could even get a word in edgewise. Optically, it was not a good look, but it was a necessary decision. Remember, Apple was in disarray, and the Microsoft deal ensured cooperation in the design of computers. It ensured the sharing of patents, and it ensured Mac users would continue to be able to use Microsoft's popular software programs. Now, despite the shotgun marriage, a decade later, in 2007, Gates and Jobs made a rare joint appearance at the D5 All Things Digital Conference and appeared to be best friends forever, with Jobs repeating a line from the Beatles song, Two of Us, telling Gates, you and I have memories longer than the road that stretches out ahead.
I like that. Best Friends 5 Eva. I know what show you watch. And by the way, Bill Gates totally milked that moment. I mean, he just let the applause wash over him for minutes on end. It was fascinating. All right, let's move on now to other company news, because Disney is raising prices of its streaming services, with the lowest cost offering climbing 25%. Tim Nollen, senior media tech analyst at Macquarie, joins us now. Disney rose in regular trading, like most of the stocks in the S&P 500, but this is something that's going to feed into its outlook and which it's going to use to talk about its profitability target for its streaming service, right?
Yeah, Disney reports, is it day after tomorrow? Or is it tomorrow? I get my days mixed up this week.
I know, it's been a long week so far.
And there are a lot of things happening with Disney. So, Bob Iger said when he came back as CEO that there would be that the streaming services are underpriced, right? And so we've already seen at least a couple of price increases. This one on the lowest price tier, the advertising tier, which in my opinion is one of the most important tiers for Disney, because the ability to monetize all of that, all of those audiences with higher priced programmatically delivered ads, I think is an important driver of Disney's growth. But in addition, there's a lot of news we could be getting tomorrow. I mean, they'll have an update, I hope, on the venue service, the sports streaming JV service. An important driver for all these companies involved. The ESPN itself over-the-top launch coming next fall. Never mind all the other things going on at Disney. So there's a lot of streaming information to come out potentially. Remember as well, Disney had said we'd be probably looking at an operating loss for direct-to-consumer services in the coming quarter, Q3. Fiscal Q4 is the really key quarter, which they've been targeting for at least a couple years now as being the real break-even quarter.
There are a lot of questions about the future, but of all the big streaming services out there, they have to be one that's probably a little bit more stable. We get Disney earnings, just double check that. That's actually going to come before the bell tomorrow. After the bell, we're going to get one of their competitors, Warner Brothers Discovery, which is in much different shape than Disney. What are you expecting?
Well, we downgraded Warner Brothers Discovery, WB stock, just a week or so ago on the news that they had definitively lost the NBA rights renewal with an asterisk. There's potentially a lawsuit to come.
Yeah.
We'll see what happens there. But we thought the NBA rights were a very important component to WBD's streaming future. Never mind its linear present, but the streaming present and future. Without those NBA rights, it's going to be tougher, I think, to build that max streaming service over time. So I'm a little bit anxious on that. Now, that won't affect the quarter, of course, they're going to report. We're looking for, flat-ish earnings, I think, at WBD.
Yeah.
They've been cutting and, several times the expectations for the annual earnings to come.
Is there a growth story here, or is this where we're just going to hear a lot more about cost cutting and just kind of?
It's cost cutting for now. I had been hoping that an NBA rights renewal could help spur some optimism on Max, the streaming service. Now, Max's international launch could help drive growth in D2C, and we've had some improvements in the advertising business. So the linear networks could be stabilizing to some extent. So it might not be all bad.
Might not be all bad, but the story is not quite there yet. And a lot of investors' focus now is whether this company needs to be broken up. What's your take on that?
Gosh, there's been so much corporate intrigue across the sector. The tricky part about breaking up a company like this, that, by the way, just got together with, Warner Brothers and Discovery 2 and plus years ago.
And the streaming depends on the legacy business.
It is exactly that. It's that the streaming depends on the content. And so if you keep the streaming and the content together and when you separate the linear networks, how do you allocate out the different content, across those different properties? And I don't know what happens to the debt. Apparently, the argument to do this is to, place the debt on the linear side. I don't know that the debt holders would necessarily want that. So that is the cash-generating business, but it's a tricky thing to separate like that.
All right, Tim, it's not something that's going to be answered, I think, in tomorrow's earnings call, but something that David Zaslav and company will definitely need to face. Tim Nollen, senior media tech analyst over at Macquarie. Thank you so much.
I don't understand it, though. I feel like of all the ones they have, of the streaming services, they probably have the better content. I mean, Max is pretty much the primary service that we use. And now it's because they just
Because of HBO, specifically.
Or
because of Dr.
My
Pimple
wife
Popper.
watches a lot of those Discovery shows, like those reality-type shows. I kind of watch more of the HBO, the bigger stuff.
The prestige
and then my
TV
son
stuff.
watches some of the, I don't know what the heck he's watching, like driving, and I don't know.
He's watching sports.
I don't know.
Let's face it.
The kid's giving me a heart attack.
Well, speaking of Warner Brothers Discovery and markets, it's been a rocky week for folks in the financial markets, and it's only Tuesday. The payoff, though, is coming this weekend when season 3 of the hit HBO series Industry premieres. Then you can watch other bankers, junior bankers in the city, try to navigate volatile markets and even more volatile clients. The first season debuted in 2020, and its third season is set to debut this Sunday on HBO and the Max streaming app. We're thrilled to have the creators of Industry in studio with us, Mickey Down and Konrad Kay, the showrunners. Thank you guys so much for joining us.
Thanks so much.
So season 1 was about fresh graduates getting permanent job offers, and some of them got it, some of them didn't. Season 2 explored crypto through a billionaire investor, kind of an Elon Musk-like character. What are you focusing on in season 3, and how did you arrive at this theme?
Season 3 primarily is about expanding the canvas of the show, and we do that through an exploration of ESG, ethical investment, social impact investing, which we thought was a quite fertile ground for exploration, shall we say.
Yeah. You think people are going to watch that about ESG? I mean, not to rain because we talk about it all the time here, but as an entertainment show, I assume you made it a little sexier than that.
It's a little sexier than that. Okay. I mean, I made it sound like it was an academic lecture, documentary, but it's a little bit more sexy than that. I mean, like it's a little bit of a playful, tongue-in-cheek look at that that part of investing.
And also, you have an incredible star too. You have Kit Harington, Jon Snow, as the CEO founder of this startup. I know that both of you worked in the city. Mickey for a year, Konrad for 3 years. What is it about the finance industry and the trading floor that makes it such a good backdrop for compelling storytelling, whether it's about ESG or whether it's about crypto?
They're just they're very interesting ecosystems. They pretend to be not very hierarchical, but they're very rigidly hierarchical. There are very few places in the world where you sit next to someone for 16 hours a day. You spend more time with them than your spouse or your extended family, and still you barely know them. And like we wanted to make trading feel adrenalized and make it feel like an action sequence, make it feel like a sports movie. And it felt, still like one of the few places where it feels like the buzz and adrenaline is something that translates very well to televisual storytelling, I think.
One interesting thing, though, about the stories, too, I mean, there's been so many movies and series about Wall Street and finance in general here, and they tend to paint either a villainous picture of Wall Street or kind of the heroic picture of Wall Street. This kind of falls somewhere in the middle, and I'm kind of curious as to how you had arrived at that, because most of the people in the show seem miserable. Like they hate their jobs, even though most of them are wildly successful. Right, they're all wildly successful, but they all seem to hate their jobs here. Is this like hitting close to home? Like, where did that come from?
Well, we were not very wild. I wouldn't say we were wildly successful when we were in finance.
Chewed up and spat out.
Not a reflection of that at all. But I mean, look, the show was kind of born out of that what you were saying, which is like most of the depictions of finance industry are from a top-down lens. They're about people who already have all the power, which means that their bad behavior is slightly less excusable. Whereas our show is about people going into finance for the first time. It's about young people who are able to make mistakes. Sometimes those mistakes are understandable, sometimes they're excusable, sometimes they're not. But that's why I think the characters are slightly more empathetic than they would be if they were 30 years into their career.
Was there any discussion here about how viable a show effectively about finance and trading would be? I mean, we talk about sort of these, industry type shows, whether, it's like a medical show or a cop show. That's more palatable to most people because everybody has some interaction with that. Finance, for a lot of folks that don't work at Bloomberg, is just kind of so over their head.
For sure.
So how did you have the confidence that you were going to get a broad audience and not just a bunch of Wall Street nerds?
I mean, we could do with a broader audience, to be perfectly honest. The one thing I'd say, I think a fair criticism of the show is like we went very hard on the authenticity. So a lot of people listen to the first 2 seasons, they're like, this is effectively technobabble. Like we can't make head or tail of what they're talking about. But it's to the credit of the directors that we use and the quality of the actors that we have that the emotional stakes of every scene is still very clear, even if you don't understand what they're saying all the time.
Well, and one way you do that is through your characters and the characters you choose to highlight. And what I appreciate about Industry is the one character who's a complete natural at sales trading, who does it. She's gifted at it. She's complex. She's layered. She's arrogant. She makes a lot of mistakes. Is an outsider, right? You have a Black American woman working in London. She is out of place, yet you choose to tell the story through her. Why is that?
Well, exactly as I was saying. I mean, I think the expected route into a show like this is from the sort of top-down, white, very privileged lens. And the show to us it's an outsider story, as you said. It's picaresque.
Yeah, exactly.
It's about someone coming into a world which they're not really expected to be in and flourishing. And I think that's the thing that makes it slightly different to the other things that have preceded it.
The show's about power, right? And so it would be a really boring show if you start someone with a load of power and then they think about how to lose it. It's far more interesting to start somebody with no power and see how they go about claiming it.
And that's such a contrast to shows like Billions, where, Romain was talking about some of your characters seem kind of miserable on the job. Everyone in Billions seems really happy with their job, but these guys are kind of conflicted. I know you have some finance insiders, some real life hedge fund managers and traders that advise you on the trading floor action and scripts and the dialogue. Have you ever rejected anything they've proposed?
They're very, very good. They're always ahead of the curve, but we've rejected stuff when it's patently obvious that they're trying to get their own back on someone in their personal life.
Oh, really?
Yeah, they like to shoot some shots, I would say, some of them.
I am curious, though, and you also have a Wall Street, or I should say, finance background, if you will. I guess technically Wall Street, because Morgan Stanley, go USA. But give us a sense here. I mean, we talk about this idea of the realism versus the fantasy that we often need in television and movies in order to keep people grounded here. Well, how did you sort of find that balance?
Well, I mean, look, the first version of the show that we wrote was just not going to fly with HBO at all because it was almost documentarian in how realistic it was. It was about, especially, I was in investment banking, so it was the sort of, M&A working to 2 o'clock in the morning. Yeah, I mean, that no one wants to watch a TV show about that. Yeah. So that's why we got rid of that after the first 2 episodes. But that, I mean, having this sort of the tightrope between authenticity and actually entertainment was quite difficult. And actually, I think as the show has progressed into season 2 and season 3, as the characters have become a lot more powerful and have a lot more responsibility, we're able to do things with them which are higher stakes, which is more inherently dramatic. I mean, season 1 was really about the minutiae of working on a trading floor or in an investment bank, and season 2 and 3 are about these big macro things and changing finance, as you outlined before.
I hate to put you on the spot, but how much further do you think this can go in terms of extra seasons, meaning that they're centered around a certain theme here, or you still have some ideas out there?
Oh, absolutely. Yeah. We'd love it to go. We'd love to do a full season.
We'll do it as long as HBO keep giving us the keys to the car.
Okay, all right. Well.
So AI, the yen carry trade, that's all in the scripts for.
Oh, for sure.
But behind the scenes of the Fed, that's what we really like to know.
I think I read that show is in development somewhere.
Yeah. Is it?
Yeah, it is. Yeah.
Oh, okay, there you go.
I think you guys need to get in on it, and there needs to be some convergence.
Yeah.
Some crossover.
We'll hire some lawyers.
Mickey, Down, and Konrad Kay, thank you so much. Congratulations on the new season coming up on August 11th. Really appreciate your joining us and stopping by. Industry premieres season 3 on Sunday. Let's take a look at how markets closed on the day. It was a turnaround Tuesday, but we definitely lost steam in the final hour of trading, Romain, because at one point gains were about 2.6% for the major indexes, but you can see they're up just more than 1% for the S&P and the Nasdaq. The VIX also has come way back down.
Yeah, still looking though at those yields now camped out below that 3% level, even with the reinversion of the curve here. That is the direction most people want to see, a direction that's still got to be ratified by the Fed.
This is The Close on Bloomberg. It is official. Kamala Harris is tapping Minnesota Governor Tim Walz as her running mate. Bloomberg Balance of Power co-host Joe Mathieu joins us now with more. So Tim Walz was not necessarily on most people's short list in the early days. He's not Josh Shapiro, he's not Mark Kelly, and he's not DeBusschere because he doesn't help deliver a battleground state. What does he bring to the table then?
Well, it's an interesting question, and I think that we have to think about geography a little bit differently to understand what the Harris campaign is doing here. It's not between the eyes on actual electoral votes in a specific state like Pennsylvania or Arizona, like you mentioned, Senator Kelly, but it is somebody who can speak to voters in Rust Belt states like Pennsylvania. That has been his MO as a politician, and it's one that we're going to see unfold a little bit less than an hour from now. They're going to be appearing on stage for the first time in Philadelphia. It is not a coincidence that this is starting there. And by the way, Governor Shapiro is going to be speaking in part of this whole production here to introduce them. But look, he's got a great story to tell in the eyes of Kamala Harris and the progressive left that had some issues with Josh Shapiro when you look at the finalists here. And to Tim Walz's credit, he was in the final 3, the final 2, as we reported here at Bloomberg. It finally came down to a media leak this morning. We know that Kamala Harris went to bed last night, they tell us, not knowing who she was going to pick. It came down to the last moment like this to the extent that they had speeches and signs made up for a couple of different scenarios here. She went with Tim Walz. He's on his way to the stage right now with her at Temple University.
So give us a sense here, Joe, when we talk about this idea of what he brings to this ticket. So the idea is that if he can communicate with some of these voters that maybe Kamala herself would have maybe had a little bit more trouble connecting with here, is that going to move the needle? I understand that Minnesota itself might not be the issue. I understand Pennsylvania, Ohio here. But given that he is not from Pennsylvania, from Ohio, from Arizona, from these other states here, is that going to carry? Is that really going to translate?
I'm not sure that it's going to matter, frankly, who she picks at all as vice president. This is a big story today, Romaine, and you've covered a couple of elections to know. Are we going to be talking about VP selections 2 or 3 weeks from now once we get beyond Chicago? Outside of a debate between Tim Walz and J.D. Vance, probably not. But he checks some boxes. The campaign likes to think he checks the normal box. He's the one who came up with the whole weird label for Donald Trump and Republicans right now. And they want to show someone who is stable, someone who has good chemistry with Kamala Harris and can have a sense of humor, which allows her to take a little bit more of a serious tone at the top of the ticket here. But it'll be interesting to see how they both play together on stage. This is their first chance today, and we know that they did not have a great relationship. They didn't know each other terribly well before they met at the Naval Observatory last weekend. So this is the beginning right now in real time.
Yeah, it's interesting that they don't have a pre-existing relationship of any sort, unlike some of the other final contenders who are also attorney generals and therefore were kind of in the same club as Kamala Harris.
That's right.
What kind of role will the other contenders have, Shapiro, Kelly, or DeBusschere, play in the campaign?
That's a great question. And look, in the campaign, they're going to be strong surrogates, and we'll see a good dose of that from Governor Shapiro tonight. People have asked if they could play a role in a potential, Harris-Walz administration, and that could be true for some of them, but they're also pretty valuable where they are, certainly when you think about Senator Kelly in Arizona here. But considering the attacks that they're getting already, it's kind of interesting that J.D. Vance has been floating this idea that it was an anti-Semitic choice by not going with Josh Shapiro. He also says that Tim Walz is dangerously liberal, just like Kamala Harris, and so the lines are being drawn.
Dangerously anti-Semitic? Is that? Just because
dangerously liberal.
Oh, okay.
Yeah, that's
and it was anti-Semitic not to choose
with
him.
the anti-Semitic part, I'm a little confused. Is there something more to that?
By not choosing Josh
Shapiro,
who had a harder line on Israel. This is something that J.D. Vance has said twice today that we'll play for you coming up on Balance of Power.
I can't wait to hear that. What's his line on Israel?
Tim Walz or J.D. Vance?
Yeah.
Well, I think he's a hardliner, and I think Benjamin Netanyahu has made clear that he would not mind seeing a Trump 2.0.
Yeah, he certainly has made that clear. In fact, you can catch Joe Mathieu, Kayleigh Lyons at the top of the hour. They'll have a fuller breakdown here of some of those policy positions. In the meantime, we turn our attention back to the markets and the potential market-moving events over the next 24 hours. We're going to set you up for what to watch when we come back after the break. This is Bloomberg. All right, let's push ahead to the potential market-moving events over the next 24 hours, and we start overnight in Europe with earnings out of a company that I think everyone is focused on.
Yeah, it's the AI of healthcare, as Katie Greifeld likes to put it. Novo Nordisk coming out and giving us a sense of the demand for its weight loss drugs. And then we move things over to the U.S., where there's still plenty of earnings, including from Disney, which just raised its prices on its different streaming services and its bundles.
Hilton, CVS, Shopify, Lyft, also among those reporting before the bell. After the bell, we're going to hear from Robinhood, Zillow, and speaking of streaming, Warner Brothers Discovery.
I know. What can they say at this point? They're not going to be announcing any kind of split up. No, they're not in a position to lower prices. They've got to reduce their debt burden. So they need cash flow to come in.
So they're going to raise my prices? Is that what you're saying?
Everyone's raising prices.
I mean, I like 90 Day Fiancé, but not that much.
Well,
yeah.
If everyone raises prices, what choice do you have?
All right. Well, those earnings could potentially move the market. So, too, could the release of the latest NBA mortgage applications. A lot of focus. That huge drop that we've seen in rates in the Treasury market. Does that translate to mortgage rates just yet?
There's a lot of open questions there.
Stick around. Balance of Power coming up next. We'll be back tomorrow right here on The Close, right here on Bloomberg.